Welcome, everyone, to today's FinTech Hot Seat Head-to-Head. My name is Craig Jeffrey, and I'm the founder and managing partner of Strategic Treasure. Our topic for today is working capital management, and we're pleased you could join us as we consider the challenges and relevant solutions in this space. First, about our format. Each company has 9 minutes to present, followed by 4 minutes of question and answer. For the first-time attendees of our FinTech Hot Seat Head-to-Head, please note that we use an active timer to provide clear visibility of where we stand throughout each presentation. The color of the timer bar shifts a bit ahead of the time to transition to the Q&A section, so the presenter has a visual clue, and we have a visual clue, to gracefully close out that section and move to the question. For audience questions, if you would like to ask a question to a particular presenter or about the topic in general, please put your questions in the chat box, and I'll try to get to as many as we can. Time flies in these presentations, so type in your questions as soon as you can. I'd like to welcome our participants for today's FinTech Hot Seat Head-to-Head. From Levantor, it's David Fry. From Kariba, it's Dory Malouf. And from Demica, it's Andrew Holmes. So thank you to each of them and to their companies for joining today's head-to-head. Now let me first begin with covering some of the challenges. So what are some of the challenges? Optimizing the cash conversion cycle, receivables, payables, the process that we move to put money into the cash conversion cycle and retrieve it is complex. So reducing day sales outstanding, improving the collection times are significant challenges to organizations. In normal times, in times of stress, they become more acutely focused on. The second point there is accelerating supplier payments without impacting cash is a challenge, right? We may want to get paid faster from our customers. Suppliers may want to extend payments without impacting cash. There's a number of challenges, and we can move from a win-lose to a win-win situation with some adjustments there, but that's a challenge. As we move across to the right, you can see enhancing liquidity through alternative financing. So the idea of using supply chain finance options is having a third party inject cash, or maybe the company inject cash into the receivables and payables. So maybe I can pay later, but my customer can receive funds sooner. So it doesn't have to be the binary, I pay later, you receive later. And secondly, lowering the cost of capital with third parties. Some participants in the supply chain, some counterparties have better credit ratings, and participating in some of these options can make it so that there's a lower cost of capital to other parties who may not be able to enjoy certain rates. We move down to the lower left, this idea of balancing efficiency and scalability. People in AP and AR often focus on efficiency, and management often focuses on scalability. How can we grow our businesses without breaking our balance sheet and do it in an efficient manner that won't take massive amounts of resources? So the automation of order to collect and procure-to-pay workflows matter. You may use different terms for those flows. And secondly, and finally in that section, ensuring a seamless integration with the ERP systems or an administrative system, right? You want to have updates to them, not have a separate process for supply chain finance, for example. They need to be integrated. And then finally, from what we're covering today, is mitigating risk in working capital decisions. So addressing credit and counterparty risks is always at the front of the minds of credit managers, and treasury and other finance professionals care about that as well. So how can they be addressed effectively? And then near and dear to the treasury people on the call would be managing cash flow forecasting and doing it in an accurate manner. Those are 4 areas of probably about 8 areas that are significant challenges to organizations. So we've asked each of the presenters to address some of those or other challenges in the cash conversion cycle, how they look at the flow, how they apply their solutions to create benefits for their customers. We'll begin with David Fry from Levantor. I'll bring the slide down. Okay, I'll let you bring up your slide. Some, and I'll let you know when it's ready, and I'll start the timer at the beginning. I can see the screen well. I'll go off screen while you're presenting, David, and we'll turn it over to you. Thank you and welcome, David Fry from Levantor. You may begin.
Thanks, Craig. Great to be on the hot seat and presenting to everyone today. Thank you very much for your time. I am the CEO of Levantor. Levantor, we are a working capital specialist that is, if I can just change the screen, there we go. Working capital finance specialist. We have been funding since 2017, growing steadily, now doing about $10 billion of short-term working capital finance per year. Currently, we've got about $1.5 billion of financing outstanding, just to give you a sense of the scale. Our focus, our unique element is that we have a large multi-funder panel. This is made up of about 25 financial institutions at the moment, combination of big global banks, regional banks, trade finance specialist banks, and non-bank asset managers. And very, very importantly, this group of funders has credit appetite for unsecured short-term exposure to mid-sized corporate non-investment grade. We can do large corporate investment grade, absolutely, but what really sets us apart is our ability to provide unsecured credit to non-investment grade corporates from anywhere from about $500 million in annual turnover and up. Typically, the sweet spot is about $500 million to $2 or $3 billion in annual turnover. And because we can provide that type of credit at that scale to non-investment grade, again, very importantly, on an unsecured basis, it makes it very, very simple and effective to insert that credit in order to enable sales between suppliers and buyers. So what do? We make it easy to defer payment on supplier invoices. That's the core of what we do. We really focus on this, but what we'll see is it can really be applied in a lot of different ways for different objectives. And importantly, in our ecosystem, this is very relevant, not just for the mid-corporate non-investment grade companies that tend to be the obligors in our transactions, but it's very important for those large corporate companies, investment grade, who sell to companies that are mid-sized non-investment grade. It's very important for those large corporates who have critical suppliers who are mid-sized corporates, non-investment grade. It's very important for institutions, financial institutions, who are looking for ways to access assets in their target market, who are looking for ways to support their clients, who are looking for ways to build relationships with new clients. And it's very important for a whole range of partners that we work with, where we're able to support their clients. Their clients who are either large corporates or mid-sized corporates who need this type of solution, because we can basically insert, embed, white label, refer the funding that we're able to provide through our multi-funder panel to those situations. And so very basically what we do is, this is all B2B. So we have in this example here on the screen, we have a corporate supplier who is selling goods or services to a corporate buyer and invoicing that buyer. And the buyer wants to be paid, wants to pay later than when the supplier wants to be paid. So corporate supplier, for example, has 30-day payment terms. The buyer needs 90, 120 days. In contrast to other sorts of traditional supply chain finance programs, there are some important differences here that make our solution extremely simple and extremely scalable. And the first of those simplicity factors is that we do not need any change in the underlying commercial contract. We don't need any change in the invoice, any change really in the processes. All that happens is the buyer basically sends us a list, transmits us a list of invoices that they want to defer payment on. We use our funding panel to source the cash that pays the supplier when due or early if the supplier wants, and the buyer pays later. And again, just to stress, there's absolutely no security that's required from the corporate buyer. There's no IT integration for either the supplier or the buyer. It's a fully digital process, really just click to accept the obligation to pay on the deferred payment date. The supplier's involvement is minimal to none. If the buyer does not want to involve the supplier, we don't need to involve the supplier. And importantly, we have a very broad view on what constitutes an eligible payable. So we do obviously lots of goods, different types of services, including rentals, including tax payments in some cases. So it's really a very, very flexible tool that can be used in lots of situations. And so where we tend to see this adding a lot of value is obviously we go directly to mid-sized corporates to give them the option to defer payment on their supplier spend. It's really for them a very flexible cash management tool. We don't have minimum utilization requirements. And so it gives them that opportunity as and when they need it to defer payment, conserve their own cash. We do have clients, mid-sized corporates, who use this in some cases more as an offensive tool, additional capital that they have then to go to their suppliers to offer them early payment in exchange for either new early settlement discounts or take advantage of discounts that they're not currently using. So it's really just additional capital to make that treasurer's life a little bit easier in optimizing cash versus profitability. For large corporates, this isn't necessarily about their working capital, but this is about, on the customer side, enabling sales. So the large corporate who's got payment terms of 30 days has its customers coming to it saying, we need longer payment terms, or will you join my traditional supply chain finance program and extend terms another 60 days and then discount the receivable? Here it's different. This is a basically sales finance, vendor finance, customer finance that makes it easy for your customers to defer payment so that they can buy more from you, so that they have the sufficient working capital finance to buy the volumes that you want to sell to them. Similarly, on the supplier side, we don't do traditional supply chain finance, but what we do is purchase order finance. So pre-invoice, you submit as a large corporate, you submit a large PO to some of your critical mid-sized suppliers. You know that that's going to put a working capital burden on them. They have to pay their suppliers before they can raise the cash from delivering to you and invoicing you. We come in and cover that gap. So it's really about injecting working capital finance into your client, your customers, and your suppliers. Banks obviously are funders, but they're also partners, and partners we can very easily plug into them to make our solutions available to their customers.
Excellent. Perfect timing too. Thanks. If you can drop the slide down if you'd like, and we can shift to the question area. So thank you, David. The first question comes from the audience. It's Gene asks, how does this affect the buyer's balance sheet for corporates? So supply chain financing, et cetera.
So we have a couple of solutions, but in the simplest solution where the supplier is not involved, For the buyer, typically this would be classified as a short-term financial liability. And in our experience, the clients that we use this, and this is really companies $500 million up to, in some cases, 50 billion. The important thing is that this does not trip any sort of covenants against additional borrowing in their secured credit facilities, in their ABLs. And that's because we're paying suppliers to extend existing payables.
Right. The next question I have for you is, how do you go about securing sufficient credit capacity from your funders before it is needed, right? You have to have enough capacity.
Yeah, so we work in a very open way with the companies and with the funders. It starts with the company saying, I expect defer, this much volume on an annual basis to these suppliers, and I would like to defer it by, let's say, 60 days. That allows us to work out what the required credit limit is, and we go and we get that from the funders. It's all uncommitted. There's absolutely no unutilized fees, no legal commitments. It's really a commercial understanding that we work toward with the corporate and the funders.
Right. You answered one of the questions in the chat box already. So on the white labeling, do I understand it? Can the white labeling be for funders, let's say a bank, or can it be for the companies, or both?
Yeah, it can be definitely for banks. You can think of it as an add-on to your existing receivables finance solutions or supply chain finance solutions, as well as a very easy way to enhance or add a distribution capability. So we have 25 financial institutions that are regularly funding with us now. Very easy for them to provide that funding behind you. You control the client relationship. For non-banks, some examples we have are various types of fintechs, payments platforms, FX platforms, where their clients are coming in to make corporate payments. We can offer the option to defer payment at that point.
Okay. How can invoices be sent in to your platform? Just files on a schedule, APIs, other methods?
Whatever's easiest. We don't impose a requirement. We can connect. We can take an upload. Most of our clients just take a download from their ERP in whatever form it comes out and just email it to us. It's really that simple.
Okay. And can users know immediately if the invoices are eligible?
Yeah. So it's a pretty quick turnaround to say that these invoices are eligible. It's usually a couple of days between the request and the funding, and for most of our clients, that's because they know their ledgers, they know in advance how long before they're going to pay, they need to pay. So it fits perfectly within their procure-to-pay process.
All right. Thank you so much. I have a couple more questions. I see we got to every question that came in the window. Thank you so much. Excellent job, David and Levantor. We really appreciate it. All right. We're going to begin. We start our next section in a moment. We're going to bring our first poll question up. This is for the audience. Go ahead and answer all that apply. And Dory, if you'd like to load your slide deck, that'll be fine too. While we're taking this. So what are your organization's biggest challenges in optimizing working capital? Select all that apply. There's 6 options. The last one is other, or I'm unsure. So it's DSO on the receivable side, payables, inventory, alternative liquidity, or the efficiency question about automating order to collect or procure to pay. Right. Excellent. A good mix. DPO, DSO, pretty even. Inventory, alternative liquidity solutions, also even with the efficiency question, automating coming in the middle there. All right, we'll close that off. And thank you. Thank you, everybody, for responding to those. We're going to shift over to Kariba and Dory Malouf. Dory, your screen is full. You're on, and you may begin.
All right. Thank you, Greg. Thank you, team. It's humbling to be a part of this conversation with leaders that are on the webinar today. I'm Dory Malouf. I run the value engineering practice here at Kariba. I come from the practicing side of Treasury. I have actually launched a working capital program in practice. both on the receivable side and the payable side, inclusive of dynamic discounting as well. So let's talk about a little bit of what we focus on here at Kyriba. We talk a lot about gridlocked, okay? And when we talk about gridlock, what we're referencing is data. Data right now, when it comes to receivables and payables, as the folks listening on the call would know, you're talking about thousands, if not hundreds of thousands of lines of data, depending on the size of your organization, whether that's on the receivables or the payable side. And when we talk about gridlock, is that data today is in silos. It is either in the ERP, or it's in other internally used platforms to help manage invoicing. And it's hard to get to. It's hard to get to in terms of extracting the data and consolidating it into a more readable form. It's hard to rationalize it and get it to make sense to what you need to do with the data. And it's hard to make sure that that data is right? That data is cleansed. So you end up in a situation where it's garbage in, garbage out. So what we've done is we've built what we call a liquidity performance platform, because working capital is about so much more than just payables and receivables. You have to see the full picture of working capital for it to be optimized and you to be able to perform effective management of that working capital as a competitive advantage for your organization. So it takes that one-stop shop solution to be able to manage it effectively when you're looking at your cash within treasury, when you're looking at your payments workflow within your AP infrastructure, or risk management when it comes to cross-currency management or interest rate management. That all comes together in a connected platform that takes that data and rationalize it for you and can extract it leveraging APIs from any internal platform that it needs the data to be extracted from. Let's peel the onion on why we focus in this area across functional view of working capital versus just an isolated view on payables or an isolated view on receivables. So when you look at the cash conversion cycle that Craig eloquently referenced up front, it encompasses all of these, right? It encompasses cash, it encompasses receivables, it encompasses payables, and of course, it encompasses inventory. So when we look at cash, you need to be able to manage your treasury activities in one location to have a view of that cash. Okay, so you need to be able to look at your daily cash positioning process. You also need to look at your cash forecasting process, including your bank relationships, because ultimately they are the funders, they are the credit that you need for funding any program. So that is a piece of working capital. From there, you got to look at risk management tied to currency risk, as well as interest rate risk, because ultimately that will impact your positioning of cash, as well as your balances, depending on the currency fluctuations, which ultimately would translate to your P&L. When we look at payments, you need to, whether it's on the payable side or any other form of payment, you need to manage that as well. Whether it's a credit card payment, a wire payment, ACH payment, check payment, any payment type, that is a component of what you do with your supply chain financing program, right? Ultimately, the payments have to go somewhere. So we have a platform where you can manage all that in one location. The other component is connectivity. When we look at connectivity, it is not just connectivity to your internal platforms that house the data for effectively managing working capital, but it's also connectivity to your banks. connectivity to make sure that whatever is flowing through your liquidity ecosystem is positioning your organization for optimal returns on that cash and optimal returns on your working capital program. You can't do that in different siloed platforms. So when we look at the working capital piece, which is the focus of today's conversation, we have the ability to manage both the receivables and the payables aspects of a working capital program in one location. So for example, on the receivable side, you will have the ability to not only manage the program, but run KPIs tied to the program. Because the program is only as effective as it is saving you in terms of accelerating your cash in the door, as well as the interest that you're paying on that program in comparison to outstanding interest rates in the marketplace with your bank relationships. So it's not only just managing the program, but also making sure that that program is generating the effective returns that you expect on it, and comparing those returns to what other programs within your bank relationship can offer. So it's a consistent optimization of your receivables program. The ability to pool the program and run either factoring or receivables financing, this invoice discounting, all in one location, and track it with connectivity at the central piece of its success, meaning connectivity to both the partners, that knowing when they're what's outstanding, your funding partners, what's outstanding on your available credit, but also internally with your receivables team to make sure that it's accounted for and accounted for appropriately, so that you're reviewing your aging and making sure that you're not within the limits of aging requirements under that factoring program. And then on the payable side, that's equally as important, because that's going to give you the ability to hold on to that cash longer. And whether it's a dynamic discounting program, which if you're cash flush, you can manage within the platform, or you're trying to hold on to that cash longer, we're able to connect not just to the banks, but also to the supplier base that's participating in the supply chain financing program. So but all three parties, you as the organization, the bank, and the supplier, are in one solution, reviewing the activity and making sure that invoices are getting paid and reconciled and accounted for appropriately, all within the confines of the facility, as well as the agreements that you put in place with both your bank relationships and your supplier base that's participating in the program. The key to all of this, both on the receivables and the payable side, is the KPIs to measure the effectiveness of the solution. So when we talk about connectivity, it's that inner working connectivity across, whether it's the banks, the enterprise, or the embedded apps. But even more important is amplifying the value that you can bring to the table of accelerating your cash conversion cycle. Being able to manage that appropriately. We have clients, we have data where we consolidated 1,080 organizations and looked at those 1,080 organizations and compared our clients versus those who are not leveraging the Kyriba platform. And the average Kyriba client is able to accelerate their cash conversion cycle by about 7 days. And that's equivalent to about $18.9 million of additional liquidity accelerated leveraging our platform.
Excellent. Thank you,
Over
Dory.
to your questions.
Yeah, I was a little slow cutting over to the questions. The first one has to do with what you just spoke about with AI and analytics. You mentioned KPIs and AI. Does that have to be done within the solution? Does the data have to be within the solution? Or can your solution access, let's say, data from a corporate data lake?
It's up to the client or the customer and how they choose to manage it. Obviously, you want to be in a one-stop shop and we do have an AI strategy as well. I was supposed to get to that, but I think I was a little long-winded. But when it comes to AI, you can't have an AI strategy without a data strategy, and that's why it's important to have the connectivity that we talked about, cross system, internal, external systems connectivity in one location. To do that, what AI is capable of doing, which is research, analysis, predictions, not necessarily making decisions for you, right? But giving you the right insights to help you make those decisions reliably and timely.
Yeah, great. I see some questions coming in from the audience. I'll bring those up in just a second. Do clients have to arrange for funders? Do they arrange for funders? Can they use banks or funders that Kariba has? What are the options?
Great question. They can use their own funders, absolutely. And if they don't have one, we can provide one for them. And then that would also require, right, a lot of KYCs. And then it would be determined from that funder if they qualify or not. But we can work either way.
Question from Stephanie is, when receiving data from your bank, what's the best way to transmit? Receive it BAI2 or other?
We have an all of the above strategy when it comes to transmission, and we make it work for whatever's best for your needs, but also whatever is most economical. It can be as real time as you want it to be. If you need real time, it can be BAI, it can be Swift, it could be API, AL2, you name it, but that's entirely up to you and what your needs are as an organization.
Is if a company wants to extend payment terms while offering early collection options for companies, how can you help with that?
Well, the supply chain financing payment program, you're able to protect your supplier base by offering them payment in a much quicker cycle. Usually it's under 10 days that they get paid. You in turn don't have to pay for much longer than that. The average company is accelerating and holding on to that cash from a DPO perspective about 30 days, right? Let's call that a simple number. You can hold on to your cash about 30 days. So if your current payment terms are 30 with your supplier base, that's going to go to 60 if we take the average. All without impacting your supplier base because they're going to get paid quicker. It's just in turn, you're not paying the funder for that extended period of time. But if you want to do it, yeah, does that answer the question?
It does. That's perfect.
Okay.
Thank you so much. And you can drop the slide down at your convenience, but thanks for answering those questions. Nice job. Appreciate it.
Thank you.
That brings us to our second poll question. Thank you, Dory Malou from Kariba. That brings us to our second poll question, which is, which area of working capital management are you prioritizing the most in 2025? And so there's 5 options plus an other or ensure. Go ahead and select the top one, the single choice that fits your organization. And Andrew, if you want to pull up, should feel free to come on screen and pull up your slide deck so that we're ready to go when the time comes. Wow. This is a very treasury audience, right? Improving cash flow forecasting accuracy. That comes up a lot. DSO, number 2, and enhancing supplier payment terms and strategies. So this was a forced answer. There's only one you could pick. So very, very interesting to see the forced number 1 ranking. Andrew from Demica. Andrew is on. The screen is full screen. It looks great. And you may begin when you're ready.
Hey, thank you very much. Can you hear me, Craig?
Yep, sounds great.
Excellent. Great to meet everyone. I'm Andrew Holmes. I look after the North America origination business for Demica. Demica is a platform for managing payables and receivables finance. We talked earlier about DSO and how that's an important metric. So today we're going to be focusing specifically on the receivables finance side. So receivables financing is a very efficient form of financing. As you know, it can help you to reduce your day sales outstanding, and it also can provide a competitive cost of funds and provide the advantage of being an off-balance sheet form of financing. The corporates are using this Both leveraged and investment-grade corporates alike are using this as a source of additional liquidity. Facilities are typically structured to achieve the goal of converting your AR to cash, and we can talk about different structures that are employed. The product is widely used globally, and in many countries, it's one of the key pillar of the capital stack of most large corporates. In the US, the product still has a lot of room to grow. We estimate that there's several trillion of AR that is still not being financed globally, and about $1 trillion of that is in North America. So Demica is here to help companies take advantage of this product and finance more of their accounts receivables book. We're a leader in the space. Company's been around for about 25 years and is trusted by top banks and corporates. We currently have about 40 billion of assets outstanding on the platform. And that means in the course of the year, there's about 300 billion or just under of financing going through Demica's platform. Demica was acquired by FIS at the end of 2024. So we are now an FIS company, and going forward, we'll be known as FIS Supply Chain Finance.
Quick question, Andrew. You're on the first slide. Didn't know if you're wanting to advance it or if that's.
I will in a moment.
Okay,
yeah.
Perfect.
So just
Thanks.
doing the intro, yeah. So we have two lines of business in Demica. One is in which we sell the technology to the banks, and currently we're working with 8 of the top 15 global trade banks on this basis. They use our technology, white label it, and provide a user experience to their customers. And the other line of business is direct corporate origination, and that's what I'd like to focus on today. So here at Demica, we understand that there's challenges and there's reasons that companies are not financing their receivables. First of all is your resource constraints. Treasury teams are stretched, you're shorthanded, and you understand that a receivables financing facility takes work to set up front, and it also requires resources to run the reporting on an ongoing basis, which of course is a requirement for anyone who's financing a receivables book. They want to see the performance of the receivables, they want to see what's paid, when it's paid, and how much is paid. So that corporates shy away from this sort of financing because they know that that's a lift on an ongoing basis. The funding market is opaque. There's different classes of investors that we'll talk about today with different appetite, and every single deal is bespoke in this market. So companies are a little bit nervous about going and trying to access that, and not certain that they're going to get the best terms from that opaque market. And then finally, companies have data challenges with showing that receivables book. It ties in with the resource constraint problem, but you have to understand your data and performance of that receivables book up front, and then also on an ongoing basis. And so these are the main challenges that prevent people from financing their receivables and accessing this additional form of liquidity. And that's the reason that Demica is here. We're here to help with all of those problems. So the first thing that we help with is navigating that funding market. And so here you can see we've got several different types of funders that are actively financing in this space. And Demica speaks to over 250 different funders around the world. And at any given time, we have 50 or more funding through the platform. The first group of funders in this space financing receivables are the trade banks. And so large corporates have access to their relationship banks who will purchase their receivables for, say, 1, 2, 10, 20 of their customers, right? And these facilities are a fairly efficient form of financing. They take the receivables, they get them off balance sheet, they provide a good advance rate. The problems with this are that the relationship banks might have to hold a lot of capital against this, and they might think of that as relationship capital and be a little bit reluctant to do that. B, it's sometimes not very flexible in the structures that they employ. And then C, if you're not an investment grade company, you don't have access to this pocket of capital. But it is one of the important pockets of capital, and if you can get access to it, it's an efficient form of financing. The next group of investors I'd like to talk about are the securitization desks. The securitization desks get favorable treatment by taking a large and diverse book of receivables and putting it into a securitization structure. This is the same type of structure that you've heard about with securitization of mortgages or credit cards. So this is a form of financing that turns this into a capital markets transaction, and therefore gets favorable capital treatment and is very low cost. This is the lowest cost form of financing, not only within the receivables financing world, but it's really competitive with even up to competing with commercial paper. So if you have a diverse book of receivables that's very fragmented with a lot of thousands or hundreds of customers, that's something that's worth looking at. I also wanted to point out the factoring houses in Europe. They are increasingly eager to do transactions in North America and take North American risk. Some of these factoring houses are very large, have significant balance sheets, and are able to deploy capital at rates that are competitive with that of a bank. So factoring in Europe is very different than factoring in North America, and those funders are doing deals over here. And then the last group is the institutional investors and private capital. And this asset class has been growing rapidly, as we've all read, and within the receivables financing world is no exception. So these investors, they're very quick and they're very flexible. They have a wide range of price points that they can do deals at. They're not going to be competitive with bank pricing, but if you're a sub-investment grade corporate, there's plenty of good options in this space for financing the receivables as well. So here I wanted to talk a little bit about pricing. And so I mentioned that Demica helps to navigate the funding market. We don't have a balance sheet, but we have relationships with all of these different funders. This chart is showing two different charts of different receivable structures. On the left, it's receivables discounting or receivables monetization, where you're underwriting one or several debtors. And on the right is that structured receivables financing or securitization. If you look at the price points over the reference rate, which in many cases is SOFR, you can see that these are pretty efficient, pretty effective forms of financing in achieving a low cost. I wanted to point out that all of the companies on here are sub-investment grade. So you can see that if sub-investment grade companies are getting these prices, investment grade companies are doing even better. This is just a mix of deals that we've done over the past year. And so you can see that the pricing is very favorable. Now, another thing I wanted to point out about this slide is the range of prices that funders are coming back with. You can see that you get a wide spread of bid, and that goes to the earlier point that I said that the market is quite opaque. Each deal is bespoke. Every time you take a deal and you go and show it to different funders, you're going to get a different set of terms and conditions, and that all depends on the industry, the geography, what's going on at the funder at the time. So it's really important to run a process. If you go straight to your relationship bank, they'll give you a price, but that's not the best price that you can get. And in many of these processes, we've included the relationship banks, and we see that they can compress their pricing once they're in a competitive process. So Demica is regularly running these processes for our corporates. Funders are aware of that, and therefore they put their best foot forward when we're involved in the process. So once you find a funder, and then you're ready to go and you're going to go put the structure in place, we have a structuring and execution team that helps you to set up that facility, that works with you and working with you side by side as you go through the legal documentation and negotiation. So Demica's structuring team is there to be your partner. And our structuring team has been put together with a team of experts coming from banks, from ratings agencies, law firms, and they're there to really help you through this. Because we talked about earlier how we understand that treasury teams are shorthanded, and setting up a facility like this does take some work. So we help you with the analysis that's needed up front. We help you with the structuring work to get that facility in place. Once a funder is selected, then we go and we start implementing the platform. And the reason you need a platform is because, as I said earlier, the funders want to see the performance of the receivables book. They want to see what's been funded, how much has been funded, is it been on, and have the customers paid on time. So the platform is automating all of the reporting for these receivables finance transactions. So we use the platform to go ahead and provide transparency to the investors and also to the corporates themselves. In fact, many treasurers point out to us that an ancillary benefit of the platform is that they're able to see
I just have to jump in quick because we're at the question time. So I'll start off with a question on the visibility and reporting that you have. All of these charts, as well as the deal charts where you showed discounted versus structural finance, are those available in the platform?
The charts where we're showing different price points?
Yeah,
no, those are not available on the platform, but we'd be happy to talk to any of you offline about that. The platform is set up to automate the reporting, right? And so the reporting is automated, and that's the task of the platform, to make sure that investors have that transparency on an ongoing basis. It's not an auction platform. Each deal is bespoke, and you implement the platform for each particular transaction.
Okay. How does Demica bring all, you mentioned a bunch of different funders. Do they bring those to the table for a client as an option, or do they get their own funders?
So we run a process. What we'll do is we'll look at the receivables book, we'll understand your data, we'll understand how your receivables book works, and then based on that, we'll be able to put together a term sheet and we will run a competitive process for you. And we'll recommend which funders we should go to, but the corporate ultimately can say, yes, I'm okay with these funders, or no, I'd like to include another one. We do that all in consultation with the corporate client.
Excellent. And you can feel free to bring your slide down. The next question is how do you see the acquisition by FIS changing Demica, and will there be deeper integration to other FIS systems?
Yeah, in the long term, there definitely will be integration with other FIS systems. It's something that we're very excited about. FIS has a lot of complementary products. They have TMS, they have a collections product to help you collect and reconcile receivables. They have, procure-to-pay products. They have payments and loan booking systems, right? So definitely that's going to be something that happens over time. In the near term, it's a great opportunity for us just by meeting FIS clients and working together with them.
Sure. What are some of the most popular metrics you see your clients using in the system?
The treasurers really like to see the performance of their receivables in one place. A lot of companies are put together through acquisitions, and they don't have one view over all of their different ERPs. So they can say, "Wow, now we can see all of that in one place." You can track your dilution on a portfolio basis. You can cut it by geography or by selling entity. You can track your aging, and that's what's of interest to the treasurers, but also, of course, to the funders.
Can Demica be white labeled by funders or by the company?
Yes, it can. And that's I mentioned earlier on that there's two lines of business. One of those is a white labeling business where the funders are white labeling the platform, presenting it as their own. So many of you that are working with some of the large global trade banks are probably already using Demica's platform, but it'll have the labeling of that particular bank.
Does your platform or your service support any kind of communication with the other counterparty? Let's say a customer who's paying you, or if it's reverse, about how to use the platform or any changes?
Well, there's a service desk, and so when people have questions, it goes straight to the service desk, and we can answer those. Is that what the question was?
Yes. Yeah.
Okay.
Yeah. No, good answer. Question came up. I'll pause for a moment. Every time I go a little long, I hit a pause on the time. There's a question about funders what does that mean? That means things like banks. It could be any of the houses, like some of the things that are on the screen right now, some of those providers of funds. That's all I was referring to for funders. So thanks for that question. I have no more questions. I don't see any in the slide, and thank you so much. Really appreciate it, Andrew.
Okay, thank you.
All right, if you want to drop the screen down, we'll move on to the other. So thank you, Andrew and Demica, Dorian Kariba, David and Levantor. Well done. I think each of them probably feel it's the fastest 13 minutes of the week. There's a lot of information to cover, which is excellent. I'm going to go ahead and do a wrap up and share the screen for a minute. Yeah, so again, thank you to Demica, Kariba, and Levantor. A lot of great information shared very rapidly. A couple of things for the recap, and then we have some additional important information. What did we cover? We looked at some of the challenges: optimizing the cash conversion cycle, enhancing liquidity through alternative financing, the balancing efficiency and scalability, and mitigating risk and working capital decisions. So that was the challenge that we looked at. And what did we see, or what did we hear? We heard and saw options for white labeling across the spectrum. We saw how these tools can leverage multiple sources of funding instead of only a bilateral arrangement. Like you have multiple funders or banks or providers of capital. We discussed a reduction in agreements using a single agreement as opposed to lots of bilateral agreements. We discussed and talked about the challenge of data and the need to get information from multiple areas: treasury, payments, risk, accounts payable, and accounts receivable. The challenge of data and visibility was brought up by every provider. We heard about working capital within the context of overall liquidity management needs. We also saw how these solutions can address and help people overcome a very opaque market, making the playing field a bit more level, as opposed to only going to one bank or one location. Since more information is available, it can help you get a more reasoned deal, a deal you feel more comfortable with because it's in the market. So it removes some of that opaqueness. We also explored some of the differences, pros and cons between funders, between banks, securitization desks, factoring houses, et cetera. And we also saw that there is, in some of the models, providing support to secure funders, banks, securitization desks, et cetera. So those are that's the wrap up for today. Very pleased with each of the presenters. It's a tough job to go through that so quickly, and they did a fantastic job. I invite you to reach out to them to hear in more detail about what they're offering. Follow up with them with any questions. That makes it very, very good. Now, I'll ask you to turn to the chat box. We encourage each of you to take the Tariffs and Treasury Flash Survey. The Tariffs and Treasury Flash Survey is showing in the box. It takes most people well under 5 minutes to do that. I invite you to select it and go ahead and respond to that. That would be most excellent. So that is the Tariffs and Treasury Flash Survey. Flash means it's short, not long, and not extended. So pop that up on the screen again. With that, Dory, Andrew, and David, feel free to come back on the screen. Thank you so much. And thanks everybody for joining this version of the FinTech Hot Seat, Working Capital Management. Thank you so much for your time. We look forward to seeing you again on other webinars or on other head-to-head sessions.
Thank
Thank
you.
you, Dory, David, and Andrew.